Investors, good morning. Evan Manship here with Mainstay, making another quick video for you. Really wanted to hone in on step one of what I believe to be the three pieces of real estate investing altogether. And I tell everyone that my magic formula is hardly magic, but it's certainly revolves around three different pillars of how to get started, how to get started, how to get started. And number one of what I always tell everyone is you got to know how to underwrite a deal. You got to know how to crunch out the numbers, and you got to know how they work together, and you've got to know what makes sense so that you can understand the rest of the whole scenario. But nothing matters, absolutely nothing matters until you dig into the numbers, understand the algebra, and really put together a good idea of what's going to end up working to meet your investment criteria. So please allow this video to be a clear picture of what I believe to be step one, at least in my three-tiered process. Know how to crunch a deal, know how to underwrite a deal. Step two, understand your market, and understand your market very well. Understand the different neighborhoods, which I'll do in a subsequent video. And then number three, just do it. If you know how to underwrite a deal and you know your market, you're going to know what makes sense and how number three is even possible. So if you're comfortable underwriting a deal and you're comfortable with a neighborhood, number three will take care of itself and you'll be able to jump. So don't let this contribute to your analysis paralysis. And take this with a grain of salt and go to bat for yourself, man. Step up, and we will make sure that we can knock this out of the park together. So before I get started, any other questions, feel free to check out the additional information below. It's got my personal email as well as our office phone here to Mainstay. So give me a buzz, shoot me an email, and I'll be happy to walk you through any of this or field any questions that you have specifically on Indianapolis as a whole. So before I get started, I'm going to explain this sheet you're looking at here, probably wondering what in the world this is. It's got a lot of funny words on there too. Property level underwriting pro forma. Ooh, it sounds scary. But this is how to evaluate a deal. And you'll see up here, we've actually put the less fancy word, the deal evaluation worksheet, right up here. So I blame Clay for the fancy language. But it's essentially I had to figure out if this is a good deal or not. So I'm going to walk you through how this works, and this is a proprietary sheet that we put together. And you can see it's got an amortization schedule, and if you're going to flip it, and note wrapping, and all this other stuff. But don't worry about that for now. That's all a little bit of 201, and we're just trying to understand 101 here. But I'm happy to send this tool to anyone who wants to play with it. But first things first, you got to know how much you're paying for the thing. And money's not, contrary to what other people say, this is starting to become more of a sexy thing to say now, but money's not made when you sell the property, it's made when you buy it. And at Mainstay, we've literally got that plastered on the other side of our office. If I could walk my computer over there, I'd show you, but it says money's made on the buy. And that's true in every different aspect of real estate. So know what your purchase price is. Let's just say, for example, here that our purchase price on this thing is, let's leave it at 50 grand, that's fine. And we're going to say we're going to put down 25%, which is what they're going to make you do. If you put this in your personal name, you're going to get 30-30 terms. When I say 30-30 terms, that means it's a 30-year mortgage amortized over 30 years, which means you're going to pay an equal amount over each installment for 360 months or 30 years. So if your interest rate's 4.75%, cool, that's great. So this is all information you can plug in on your own just by understanding how much you're putting down and what the purchase price is you're offering. In addition, closing costs are, 2%. And prehab costs are things, what it's going to take to get the property up to snuff, up to get it rented. So just to make numbers easy, I'm going to say this is $5 grand. That means that you're coming out of pocket $12,500 for the down payment. In addition, it's going to cost you $1,000 to get the closing costs, points on the loan, prorated taxes you're eating, whatever it be. And then another $5 grand out of pocket to get the thing up to something that can be rented. So don't let these numbers scare you. Not a lot of people who start investing have 20 grand in their pocket. So you don't need this much money, and we can get into that more of a 201, 301 class. But people like me lend that money all the time so you can get up and get started. So don't feel like this is something you need to have. This is strictly an example. So let's say you're all in for this thing. Out of pocket, you're all in for this thing for $18,500. And then you've got, $37,500 in debt that you still got to pay back when you sell the thing, or over 30 years. Let's just say this thing rents for $900, which is probably a little steep. Let's say 850 maybe. Let's do that. 850. And vacancy is something we always is just a placeholder. We don't mess around with trying to estimate vacancy, no matter if it's a super sexy neighborhood like Broad Ripple or something that's a little bit more inner city, perhaps on the near west side. It doesn't matter. Vacancy is 10%, 10%, 10%. It's just a placeholder just to keep math easy all the way around. So we can play with this when we get into more sophisticated commercial stuff, but we always keep it at 10%. Tax expense is something that folks often ask, especially when you're getting started and especially when you're out of state. So I'm going to drag over this window here, this typical Google here, and I'm going to search Marion County, Indiana, property cards. Everyone got that? Marion County, Indiana, property cards. So it's going to pop up and it's going to say Marion County property cards. It's going to take you to this window right here. So, yippee, then you can type in your address, you can type in the owner name, you can type in the parcel, whatever it be. So, let's just type in a property that we still own. Mainstay Property Group. I click on this link here, and then it'll start an immediate download of what's called a property record card. This property record card is helpful in a couple different ways. This property record card, aside from the fact that you can see who owns it, if you wanted to contact that owner and try and purchase a property from someone off market, which is huge, or a couple different things. I mean, it's just you have their, that's my home address right there, and then you can see obviously the assessment as well. So a bunch of different helpful things. It has a little blueprint of the house, how many square feet, you name it. So super helpful thing to be able to navigate this assessor property card tool. It's easy, it's free, and it's awesome. So anyway, Marion County, Indiana property cards. Load this thing up. Check your assessment here. And this number right here for 2017. I'm making this video on December 6th of 2017. So this assessment right here, $51,000. I am going to plug in right here where it says tax assessed value. I'm going to plug in 51,000. That's just ironic. It was already 50. So you can see my tax expense jumped a little bit from 83 to 85. And then my insurance is a placeholder. You can get some estimates for this if you really care a lot, but it's not going to move much off. It could be 35, it could be 50, it could be 65. You don't know. So I'm just going to keep this at 50. Management expense is another thing that what's market here in Indianapolis is almost always a flat 10%. So 10% is a good placeholder there. Every time we underwrite a deal, we almost always use 10% as maintenance reserves just to make sure that if the furnace blows up or if the sky falls in or whatever it be, needs a new door, whatever it be, it's always going to be covered because you're tucking away $85 a month in case something goes wrong. So that won't happen, particularly if you're buying in a more attractive, desirable area with good tenants. But 10% is almost always a good number. So if we look at this, we say, look, we bought a house for $50,000. We're all into it for $18,500, including the $5,000 to get up to snuff on the rehab. So we've put $18,500 out of our pocket. Our rent's $850,000, which actually in this house it is $850,000. The one I just showed you. This is the actual tax at 2% of this number. So you can see right here, this calculation is 2% divided by 12. So this is the monthly tax you're paying on this thing. Estimated $50. 10% in management, 10% in maintenance. So it's a pretty conservative little deal. If you have another HOA or if you have some type of ancillary expense that accompanies this property, this is where you plug it in right here on your miscellaneous expense. But this is pretty straightforward here. So this will demonstrate your NOI, which is pretty healthy at $460. So that means if you bought this thing cash, if you wrote a $55,000 some odd dollar check for your property, you'd be putting $460 a month in your pocket. It's good. And if you have debt on it, which we do, our debt service is $195, but our total outflow, including maintenance and management and property taxes and all the other stuff, is $330. You're looking at $265 roughly when you take your NOI subtracted by your debt service. Make sense? Total monthly cash flow, $250, $264. So your cap rate is a good gauge of right then in a snapshot of time what your project is delivering, how healthy and performing your asset is. So this number, cap rate, is indicative of your income, your net operating income. This number right here, 460, divided by your purchase price or the value of the property, so 50. So if you do equals 460 times 12, and I should do some parentheses. Come on. 460 times 12 divided by, this is annoying me, equals 4. Naturally it backfires when I'm on YouTube here. Divided by 50, 11%, which is exactly what it shows up over here. Right? See how that worked? 460 times 12, so your annual NOI divided by your value, your purchase price, is 11%. So you'd be making 11% on your money if you paid cash for a thing. If you cut a $50,000 check and you made $460 a month, you're making 11%, which is in many cases a lot better than the stock market. But if you finance the thing, if you throw some debt on it, which you did right here, right? Remember your 30-30 mortgage and 4.75% interest rate? You didn't cut a check. You didn't cut a check for the whole amount. You cut a check for $18,500. That's closing costs, it's rehab costs, and that's your down payment. So the money you're making on the money you shelled out to get this asset up and cash flowing, you're making $265 a month times 12 divided by this number, and that's 17%. So this property is indicative of what's called positive leverage. You're utilizing leverage or debt to increase the return on your money. Now, some people don't like leveraging properties in a high manner or utilizing leverage at all. But it's very important to point out that if you do it correctly and you're not an idiot, you don't completely over-lever yourself, you can almost always have an attractive debt model to where you have positive leverage, and therefore it increases the money or your cash-on-cash return. So your annual cash flow here is $3,200, which is a nice little raise for you 9-to-5ers. And if you cut a check for it, you're looking at $5,500 in your pocket every month just for one of these things. So, or every year, I'm sorry. But this is a very, very, I don't want to say it's a robust tool, but it's evidence in how a property is underwritten just by populating a couple of these cells, the ones that are yellow here. So, certainly something that's attractive for you folks that are looking to get started or looking to overcome your fear of how do I know what's good and what's bad. This is a great way to start. Eat, sleep, and dream about this thing. And crunch out deals left and right. I mean, when I got started, it was 25, 50 deals a day, and after you're around it for a long enough time, you can just know roughly what it's going to rent for, roughly what the value is, and get an idea for what a cap rate's going to be if insurance, taxes, and everything kind of works out. So it becomes much more of an art to underwriting after you've been around it for a long time, as opposed to a science of plugging in every number specifically. So this exact same formula is how people underwrite the Chase Tower in downtown Indianapolis, the biggest building in the city, or mom and pop retail strip center right down the road, or the office building I'm sitting in, or the house you're getting ready to buy. Everything is based around this formula right here, and that's driving net operating income, dividing it by the value of the property, and indicating a cap rate. So happy to walk anyone through this, answer any questions y'all might have, detail the AM schedule for you. But in the interim, this is step one of Mainstay's directive on how we get started. Understand how to underwrite a property correctly. Understand your markets and your neighborhoods, which will be the next video on what neighborhoods are good for rentals and for flips. And get started. Once you know how to do the first two, the third will take care of itself. So email, call, info@mainstaypropertygroup.com, and we'll get you taken care of.